Something just happened that is rare. We haven't had this happen in 30 plus years. We need to be aware of when these things happen because they can potentially have major ripple effects. Hey, everybody, thank you for joining us for this special discussion that we're having here this afternoon. So, Stephen Weitzel, joined by my partner, Chad Smith. And today we're bringing you an update on the Yen-tervention that has recently happened, where the U.S. Treasury has been working with the Bank of Japan to try to arrest the decline in the value of the Japanese yen. And they have intervened in the foreign currency markets for the first time in a long time as it relates to the yen. And so we want to talk about what would have brought this about, why would they even be doing this, and what are they hoping is going to happen. So, Chad, let's talk about it, and let's begin with, we are looking here at a chart of the Japanese yen. So this is US dollar versus the yen. And so as we see this line, this blue line, go up and to the right, this is consistent with dollar strength, yen weakness, and the yen is at one of the weakest levels that it has been in 30 years, 40
decades.
years. And it has depreciated markedly in the last 12, 13 years versus the dollar. It's gone from a low in November of 2011, where the exchange rate was at 75, so 75 yen to the dollar, to now effectively 160. So the purchasing power of the yen has been more than cut in half. Let's talk about what problems is that promoting for Japan? What is the overall concern?
Well, what's interesting, you mentioned it. This is the first time that the U.S. has intervened to support the yen. There was one time when they intervened to bring the yen down in 2011 after the big earthquake. But the first time that they've intervened to support the yen since 1998 during the Asian financial
Asian
crisis.
currency crisis, right back here.
Absolutely. And so, there has been this concern that's mounting that, just another key fact, the yen right now is on an inflation adjusted basis, is back to the low levels of where it was in the 1960s, which is astonishing. Wow. So, there's a problem there. And really, specifically, one of the things that has prompted, presumably, we've heard a little bit of this confirmation from a few folks in the Treasury, or Secretary Bessent himself, but the concern is that there may be a broader potential spreading impact, like there was back in 1998 when some Asian currencies began to devalue precipitously, and it had a ripple effect. So that's one concern. But the other concern is, with the yen so weak, there's the growing need potentially for the Bank of Japan to intervene and support its own currency. But unfortunately, in order for them to do that, the way that you do that, predominantly, especially yen versus dollar, is you sell dollars and buy yen. And so that would look like the Bank of Japan having to sell U.S. treasuries, because Japan is the largest single holder of U.S. treasuries in their reserves. And so if they were prompted to sell treasuries to then be able to step in and buy yen, that would put pressure on treasury bonds, sending prices lower and therefore sending yields higher. And that's a concern for sure.
So I want to touch on just a couple things here quickly. So if we go back to the late 90s when we had this Asian currency crisis, you mentioned but didn't really hone in on it. So it was in the summer of 98 that the long-term capital management hedge fund failed.
Yep.
That almost was it was the precursor to what was going to happen with the dot-com bubble bursting, but they had a lot of leverage built up. There was a lot of inflation in Asia in the late 90s, and that happens when
Hmm.
the value of your currency depreciates as rapidly as it did. And
Hmm.
that has more recently, it's been a real problem for Japan. They have had an inflation problem. They do not have natural resources as a country. They are
Right.
importing everything. And so when you have the issues that have been percolating in the Middle East, the cost of a barrel of oil denominated in yen has gotten to be exceptionally expensive.
Yep.
And so they need to try to arrest this inflationary problem that they have. The way that they would do that is by defending their currency. But to your point, they've got to have the collateral, the capital to be able to invest in that.
Hmm.
They are the largest holder of U.S. treasuries in the world, over $1 trillion, most of them long term treasuries.
Yep.
And these currency markets are so big that you would have to have a bazooka to come in
Yeah.
and really move the needle and try to strengthen the yen back to a level where it's starting to make prices more affordable. They can buy energy, copper, whatever it is, more affordable. But they would have to dump an exceptional amount of US treasuries. And that is the last thing that the US government needs right now,
Yeah.
because the amount of money that we are paying on interest right now, in interest on our outstanding debt, we're going to get to about $1.5 trillion in interest expense each year
Yeah.
very soon.
Astonishing.
Astonishing. We're going to cross the $40 trillion threshold of debt almost any day now. And the only way they're going to be able to get this under control is they've got to have interest rates come back down.
Absolutely. And so what's interesting is in order to kind of again thwart that, but the US, wanting to thwart Japan having to resort to selling treasuries to be able to do this, they said, "Hey, we need to intervene. We need to come together and coordinate this." And so what's interesting though is that the US again to not step into the realm of selling treasuries or selling dollars, they actually for their portion of what they put into this particular program, or this intervention, about 35 billion dollars, the US sold euros, from its own reserves in order to then purchase yen to step in and support the yen. So that's one thing. The other thing is Japan, on their part, their portion of, the involvement of stepping in and intervening, they did not sell anything. They actually utilized the Federal Reserve's Foreign and International Monetary Authority repo facility, which allows them to pose their holdings of treasuries as collateral to then borrow against and come up with the capital for their intervention. So a lot of effort, coordinated efforts going on to try to, not have to resort to selling treasuries, selling dollars in order to come up with the capital to buy yen, right? Um, and what's interesting is, to your point, it's reflective of the sensitivity that both we and Japan have to the implications of rising interest rates. With these higher debt levels that we have and Japan has, every incremental rise in interest rates directly affects the expense of servicing that debt, right? And it's becoming a problem. We're getting to this point of kind of no return in both our fiscal situation as well as in Japan's.
Yeah, and I think that the we each have an existential crisis potentially looming, where the Japanese, their debt to GDP ratio has been really, really high, about the highest in the developed world for many
Yeah.
years. But they've been artificially holding interest rates down, right? So we've got this
Yes.
comparison of, what the yield on longer term government bond yields would be for Japan versus the United States. The United States has consistently been above what yields were available in Japan. But even short term rates, where the central bank sets policy, the United States has had, let's just call it a more normal central bank policy, even though there have been certainly extraordinary periods where we both had interest rates at zero for the longest time. But they even had negative deposit rates in
Yeah.
Japan for a
Yeah.
long time because they used to have a problem fighting some deflation. They have
Yeah.
their demographics, people are savers, and they wanted to incent them to get money out of the banks, go and do something else with it. And so finally, this low interest rate policy that the Bank of Japan has, they again have a lot of debt, but they have suppressed interest rates either
Yeah.
by buying a lot of the longer term US government bonds, and the Bank of Japan owns a lot of the Japanese government bond issuance, but they need to let those yields normalize. They need to let them rise, but they too are sensitive to that. But the US government knows they cannot afford to have interest rates rise much more than what they already have because the budget is already unbelievably stressed. That just suggests that we even have a budget. We don't,
Sure.
but
Yeah.
just the annual expense of covering this debt is becoming untenable. Now,
Yeah.
you and I were talking about this earlier. We go back to this chart that illustrates the climbing annual interest expense that we have on our debt. And you notice that there were a couple of times where the chart dipped down. And this isn't because the US government has ever
Yeah.
lessened the amount of
Right.
debt that they've had. They've simply had periods of time where interest rates were markedly lower. Back here during COVID, where that interest expense on debt fell by about $100 billion a year, this was a period where interest rates were as low as they'd ever been in my lifetime. The yield, even on the 30-year Treasury, was 1% or less.
Hmm.
And Steve Mnuchin, who was Trump's Treasury Secretary first time around, he wanted to term out the U.S. government debt,
Hmm. Right.
meaning he wanted to take short-term debt and exchange it for, we're gonna now borrow this money for 30 years at 1%. But in hindsight now, that looks like it would have been a brilliant idea given
Absolutely.
that the yield on the 30-year Treasury is now 5%, and the yield everywhere, even on the front end of the US Treasury curve, is 4%.
Yep.
That that would have been a very wise decision to make, but he was derided by the other side of the aisle at that point in time, as if they had done that, it would have markedly increased the amount of interest expense on the debt because it would have gone from a quarter of a percent to one, and even that was
Yep.
untenable. Well, now we're staring at 4% plus, and this number, it ain't coming down
Exactly.
anytime soon because we know that the amount of government debt is not going to fall. So what they've got to do, they've got to try to engineer the best that they can interest rates coming down on the
Hmm.
longer end of the curve, get this number working in a better direction, in a lower direction. And the last thing they can afford to have happen is that the existential crisis in Japan with their currency translates into Japan being forced to unload hundreds of billions of dollars of US Treasury bonds, which is only going to further complicate the matter for the US Treasury, and
Yeah.
then ultimately for borrowers, for
Yeah.
people trying to get a mortgage.
Absolutely. Yeah.
They've
Especially
got to
since,
get this under control.
yeah, the longer end of the yield curve in the US is what uh, drives or influences mortgage rates, of course. So the longer maturity treasuries and bonds that Japan holds are gonna, to your point, there's selling pressure, supply increases, demand's not gonna necessarily increase, then it's gonna bring prices down, bring rates up. So yeah, it's a problem, and I guess while we're presenting the situation and talking through kind of the narrative and the context, what we need to be on alert for is to the extent that this grows into a further problem, because it's these kinds of things that all of a sudden they're innocuous, it's overseas, it's really nothing, and then all of a sudden it lurks in, and next thing you know, especially because of some people may have heard who are listening to this, the yen carry trade. The carry trade being because structurally rates have been so low, dramatically lower than the rest of the developed world in Japan for so long, a profitable thing to do for a lot of institutional investors is to borrow money in Japan, borrow in yen, where your interest expense is extremely low, and then take that money and invest it somewhere else in the world, maybe, for example, the US, and then use that money to then just invest in things that pay a higher rate, make the spread, and then you just keep printing money. Well, if that spread compresses, if for example the Bank of Japan is forced to raise interest rates to deal with inflation, number one, and to deal with a more kind of pronounced way to support the yen, then that's going to compress that spread, and that could affect the yen carry trade. That could cause unwinding of all kinds of capital flows around the world, and the next thing you know, you're back into a situation where there's a currency crisis, and then it ripples out from there. So we've always got to be mindful of these kinds of things on the periphery, and then all of a sudden, next thing you know, they become front and center, and it's an issue to deal with for all the markets.
Yeah, so that could ultimately be like the straw that breaks the camel's back, where people are then forced to sell the investments that they have that have been acquired through that carry trade to
Yes.
pay it off, and we don't know exactly what that unwind could turn into. So it's the
Yep.
potential for it could turn into a crisis that we have not seen maybe in a long time. Uh, it could be nothing. It could be somewhere in between. But the reason that we're trying to have this conversation today is to acknowledge the fact that something just happened that is rare. We haven't had this happen in 30 plus years, 40
Hmm.
years, maybe going back to the Plaza Accord in the 80s. Uh, and we need to be aware of when these things happen because they can potentially have major ripple effects that are going to impact our clients. So,
Yep. Absolutely.
but anyhow, appreciate you jumping on to have this
Yep.
discussion. If people want to talk more about this, they can reach out to us, send us an email, info@reveillewealth.com. But appreciate everybody tuning in for this discussion. Hope you're having a great day, and we will talk to you soon.